Chapter 4, Completing the Accounting Cycle. We're going to describe the flow of accounting information from the unadjusted trial balance into the adjusted trial balance and financial statement. This right here is a flow of accounting information. You can also find this in your books. In the book, they use net solutions as an example throughout the chapters when discussing the accounting cycle through chapters 1, 2, 3, and 4. And I just want to show you how everything flows together. We learned this in chapter 1. We start off with an income statement, and the net income flows to the statement of owner's equity, and the ending capital balance flows to the balance sheet. From here, you can create the statement of cash flow, and the ending cash balance in the statement of cash flow should match the cash balance on the balance sheet. This is an indication of the end of period spreadsheet that has the unadjusted trial balance, the adjustments, and the adjusted trial balance. And this is where all of the information for the income statement, statement of owner's equity, and the balance sheet is prepared from. So let's take a look at a little example exercise of the flow of information. It says the balances for the accounts listed below appear in the adjusted trial balance columns of the end of period worksheet. Indicate whether each account would flow into the income statement, statement of owner's equity, or balance sheet. Office equipment is a balance sheet account because it is an asset. Utilities expense is an income statement account because it's an expense account. Accumulated depreciation for the equipment specifically is a contra asset account, and it belongs on the balance sheet. It will also be listed generally directly underneath the asset that it belongs to. Unearned rent is a liability. This goes on the balance sheet. Fees earned is a revenue account, and it goes on the income statement. The drawing account appears on the statement of owner's equity. Rent revenue is a revenue account, and it is on the income statement. And then supplies is a asset, and it belongs on the balance sheet. For more practice, you can actually do practice exercise 41A and 41B out of your textbook. If you choose to continue with more exercise with this information, you can pause the video at this time and complete those exercises and do a self-check with the solutions directly out of Angel. The income statement is prepared directly from the income statement or adjusted trial balance columns of the end of period worksheet. Beginning with fees earned, in this particular case, $16,840. So for net solutions, we're going to prepare an income statement for the 2 months ended December 31st, 2011. The fees earned was $16,840. You can get this information directly from your textbook, where it shows the information from the ledgers or from the worksheet. Rent revenue was $120, so we're going to net the two revenue accounts together for total revenues of $16,960. We're then going to list the expenses: wages expense, supplies, rent expense, utilities expense, insurance expense, depreciation expense, and miscellaneous expense. Notice, listed in order of highest to least, miscellaneous always last. Total expenses are $9,855. The difference between revenue and expenses is either your net income or sometimes a loss. And in this case, it's $7,105 of net income. This information is going to flow to the statement of owner's equity. The statement of owner's equity, and the first item presented on the statement of owner's equity, is the balance of the owner's capital account at the beginning of the period. So for Net Solutions, we're preparing a 2-month statement of owner's equity. So we need to go and pull the beginning equity. And for Chris Clark, in this particular case for Net Solutions, the beginning of December, November, October, or November 1st, he had a zero capital balance because he had not yet opened the company. Later on in the day, he invested $25,000 in the company, so that's why instead of it being a beginning capital of $25,000, it's actually an investment of $25,000. We bring in the net income from the income statement. added in $7,105, net these two totals together for $32,105, less withdrawals of $4,000. So for this particular period, we had an increase in owner's equity of $28,105. We will add the increase or decrease to the beginning capital to determine the ending capital. So Chris Clark capital as of December 31st, 2011 is $28,105. This information is going to flow to the balance sheet. Let's take another look at another example of a statement of owner's equity. Zach Gaddis owns and operates Gaddis Employment Services. On January 1st, 2011, Zach Gaddis capital had a balance of $186,000. During the year, Zach invested an additional $40,000 and withdrew $25,000. For the year ended December 31st, 2011, Gaddis Employment Services reported a net income of $18,750. Prepare a statement of owner's equity for the year ended December 31st, 2011. We'll put the title of the company, the title of the statement for the year ended December 31st, 2011. This information is not optional and will actually cost you valuable points on your graded assignments and tests. Do not fail to put the title of the company, the title of the statement, and for the period that it's prepared for. So according to the directions, Zach Gaddis capital as of January 1st was $186,000. He had additional investments of $40,000. We're going to net these two totals together for a total of $226,000. He had less withdrawals of $25,000, less net income $18,750. So he had a decrease in owner's equity of $6,250. Zach Gaddis capital as of December 31st is $219,750. I want to take a moment to point something out here. This should have been less withdrawals of $25,000 and net income of $18,750. They worded this slightly different. However, this actually still ends up being the same. Netting these two totals together still gives you $6,250, whether you're deducting the withdrawal or taking out the net income. I would personally not word this way. However, for the purposes of an example, that's fine. You can actually pause the video at this time and complete practice exercise 4.2a and 4.2b if you need additional practice for statement of owner's equity. Now, the balance sheet is prepared directly from the balance sheet or adjusted trial balance columns of the end of period worksheet, beginning with the cash of $2,065. I also want to note that the income statement, statement of owner's equity, and the balance sheet can also be prepared from the ledgers and the adjusted trial balance itself. And you can actually skip the spreadsheet if you like, because in the grand scheme of it, the spreadsheet is considered to be optional. Let's take a look at the balance sheet. So for Net Solutions, balance sheet, December 31st, 2011, we'll list our assets, liabilities, and owner's equity. So we have our current assets, cash, accounts receivable, supplies, prepaid insurance. These are listed in order of liquidity, cash being your most liquid asset, accounts receivable being a cash equivalent, supplies we could sell off pretty quickly, prepaid insurance is the prepayment of an insurance policy, and if you cancel it, this money comes back to you. Total current assets is $7,745. We then have property, plant, and equipment, which is also referred to as fixed assets. Land, $20,000. We have the office equipment of $1,800, less the accumulated depreciation of $50, for a book value for equipment, $1,750. The difference between the asset and the accumulated depreciation is the book value. Very valuable information. Total property, plant, and equipment or fixed assets is $21,750 for total assets of $29,495. So assets altogether, $29,495. We then go to the liabilities. And we list those out: accounts payable, wages payable, unearned rent, for total liabilities of 1,390. We then go to the owner's equity section. Chris Clark Capital, 28,105, came directly from the statement of owner's equity. We add these two totals together for total liabilities and owner's equity of $29,495. My assets equal my liabilities plus my owner's equity, and so my balance sheet is balanced. A classified balance sheet is a balance sheet that was expanded by adding subsections for current assets, property, plant, and equipment, also known as fixed assets, current liabilities, and long-term liabilities. Current assets are cash and other assets that are expected to be converted into cash, sold, or used up usually within a year or less through the normal operations of the business. These are considered to be current assets. Examples of that would be cash, accounts receivable, notes receivable, supplies. Notes receivables are written promises by the customer to pay the amount of the note and possibly interest at an agreed rate. We'll talk about this in Chapter 9. For now, what you need to understand is that anytime you see the word receivable, it is an asset. Fixed assets, or property, plant, and equipment, include assets that depreciate over a period of time. Land is your exception. Land never depreciates. Keep that in mind. This could end up being a question on your midterm and your final exam. Land does not depreciate. Examples of fixed assets could be equipment, machinery, buildings, land. We have current liabilities, liabilities that will be due within a short period of time, usually within a year or less, and that are to be paid out of the current assets are considered to be current liabilities. Examples could be accounts payable, wages payable, interest payable. Notice the commonality here is the word payable. Anytime you see the word payable, you need to associate it with a liability. Unearned fees, unearned revenue, unearned rent is also a current liability, and your key word here is unearned. If you see the word unearned, it is a liability. Long-term liabilities are not considered to be due for a long period of time, usually more than a year. You could have long-term notes payable, mortgage payable, bond payable. Again, notice the word payable is considered to be a liability. Owner's equity is the owner's right to the assets of the business. Owner's equity is added to the total liabilities, and this total must equal to the total of the assets. So again, assets equal liabilities plus owner's equity. Let's look at an example of a classified balance sheet. The following accounts appear in the adjusted trial balance of Hindsight Consulting. Indicate whether each account would be reported in the current asset, property, plant, and equipment, current liability, long-term liability, or the owner's equity section of the December 31st, 2011 balance sheet for Hindsight Consulting. At this time, I want you to pause the video, answer the questions, and then unpause the video to see if your answers are correct. Pause now. Okay, so if you paused, you can see and you answered, you need to compare your answers. The capital is owner's equity. Notes receivable due in 6 months is a current asset. Notes payable due in 2013. Understand that this was for the 2011, so if it was due in 2013, for the purposes of this example, it was a long-term liability. Land is property, plant, and equipment, also known as fixed assets. Cash is a current asset. Unearned rent is a current liability. Accumulated depreciation for the equipment is property, plant, and equipment. And accounts payable is a current liability. If you need additional practice for these types of examples, you can do practice exercise 4.3a and 4.3b at this time. This concludes part 1 of Chapter 4 video lectures. Please continue with your studies.